Okay, we're diving straight into an analysis report on CleanSpark. It's titled CleanSpark Earnings Review, Revenue Up 102% by now. And it looks at their huge FY 2025 performance and this big strategic pivot they're making toward AI.
And it makes a really strong case. The financials, the profitability, it's all laid out very clearly.
It is. Okay, so the core argument here really is that the company is poised for this major re-rating.
Right.
Shifting the stock from being valued like a traditional miner at a 10x PE.
To an AI data center at a 30x PE, which is a massive jump.
A 3 times expansion. That's the whole thesis. And it's where the analytical structure, well, it needs to be absolutely watertight.
That's right. I mean, the fundamentals are already there. That 102% revenue increase, the operational efficiency, their, 13,000 Bitcoin treasury?
Yeah, huge.
It all builds a strong case for them as a miner. But, and this is the key, if the analysis wants to justify those $25 to $30 price targets that imply the 30x multiple, it has to elevate that AI story from, just speculation to a credible near-term catalyst.
So to successfully shift the market perception of CleanSpark, the analysis must dedicate more structural depth to the AI and HPC strategy.
Exactly. The weakness I see right now is that the report, it relies really heavily on those impressive mining metrics to set the stage.
You mean the revenue, the treasury?
The treasury, the profitability, all of it. And it treats the AI pivot almost as this separate future thing, a speculative opportunity.
I see the imbalance. It keeps the reader's focus stuck on the solid, but, lower 10x mining valuation.
It does. It prevents the report from truly validating that 30x potential.
So I see the dilemma here. The material does identify the new catalyst, the 271-acre Texas site, the Submer partnership.
Right.
But it feels like it spends maybe 80% of its persuasive energy on what the company has already done in mining and only 20% on what it must do in AI.
That's a perfect way to put it. The narrative needs to feel more balanced to support that kind of valuation increase.
So what's the suggestion?
The suggestion for improvement is that the report needs to proactively address the execution risk and the competitive landscape of this AI transition. It has to give that section a weight that's commensurate with its impact on the stock price.
If AI is the engine for the future valuation,
it needs to be the structural centerpiece, not just a bonus feature at the end.
But let's get practical. I mean, this is an analysis of earnings, and the AI facility isn't even built yet. So how can the analysis provide that kind of rigorous, execution-focused detail without dipping into pure fantasy?
That is the core challenge. And tackling it professionally is what separates a great analysis from a good one.
Okay.
So instead of just mentioning the size of the site, 271 acres, the analysis could dedicate a whole section to projecting the potential power capacity in megawatts.
Or even revenue density.
Or, critically, the potential revenue density compared to established AI data center peers. You don't have to name a specific customer, but you have to commit to a realistic benchmarked capacity estimate.
That makes sense. So you're using established industry standards to frame the potential, instead of just saying, this is going to be big.
Precisely. For a concrete example, the analysis could look at the average power-to-area ratio of new HPC data centers. You can find public data from competitors.
And use that to calculate a conservative and an aggressive projection.
A conservative and an aggressive projection for the Texas site's potential megawatt output. Another actionable step would be to research and detail the expected timelines, construction, financing, deployment phases.
Right. Give investors tangible milestones to watch.
A roadmap with clear monitoring points. That is how you start to earn that 30 times multiple.
That's a powerful way to strengthen the bull case. Okay, let's move on. The second major point in the earnings summary, it presents this fascinating paradox.
The EPS miss.
The EPS miss. The report notes that CleanSpark technically missed Wall Street consensus, $1.12 actual versus $1.45 expected.
Which caused an initial sell-off.
Right, the algo sold. Yet, the stock quickly rallied 13% because, and I'm quoting here, humans stepped in to buy.
And that description, humans stepped in, it's evocative, I'll give it that. But for a deep dive financial report, it's really an analytical placeholder.
So our second critique is this. The analysis needs to provide a more rigorous explanation for why smart money dismissed that significant EPS miss, moving beyond the simple idea of human buying.
I absolutely agree. Just saying it happened because of human intervention is, well, it's insufficient. It almost implies this emotional, non-fundamental buying.
which kind of undercuts the professionalism of the whole analysis.
It does. The reader needs insight. Insight into the underlying accounting or the forward-looking investments that cause that disparity.
The weakness is that it doesn't connect the dots between the reported GAAP results and the strategic moves the company was making.
Exactly. Was the miss due to non-cash items? Maybe something related to that massive $1.15 billion convertible notes financing.
Or was it aggressive but strategically positive capital expenditure, things you want to see for future growth?
If the market ignores a 23% EPS miss and then rallies 13%, there is a specific financial reason for that disconnect. The analysis has to uncover it.
That's the key. And can we elaborate a bit on why that financing, the convertible notes, might cause that kind of disconnect in the reported EPS?
Certainly. The suggestion is to specifically investigate the relationship between that huge growth funding and any potential write-downs or accounting treatments that might have depressed the immediate GAAP EPS figure.
Okay.
Convertible notes they're complex instruments. Depending on the terms, they can lead to significant non-cash derivative liabilities on the income statement.
So it looks bad on paper, but it's not an operational problem.
Not at all. Experienced market participants, they're going to focus on adjusted EBITDA or non-GAAP metrics that strip out these non-operational, non-cash charges.
So the analysis needs to explicitly state something like, the street didn't care about the miss because it was tied to the non-cash accounting of the financing, which actually signals future confidence, not weakness.
Precisely. That is a much stronger conclusion than humans stepped in. You shift the focus from short-term noise to long-term strategic execution.
And what's a concrete, investigatory step to bolster that section? What should the analysis look for in the filings?
A direct comparison of GAAP EPS to non-GAAP or adjusted EPS figures. That's the first step. If the non-GAAP number is significantly higher, well, you've solved the paradox right there.
And if not?
Then you investigate whether the acquisition of the Texas AI site or maybe the accelerated hash rate expansion resulted in significant one-time charges that masked the true operating profitability.
I see. So you highlight these non-recurring expenses.
You do. And that would strongly support the argument that the market was correctly valuing the huge revenue growth and the infrastructure build-out over one quarter's accounting volatility.
That kind of deep dive is just essential for a professional earnings review. Okay, let's move to the final section, the final verdict. Buy now? The structure here is helpful. You know, a binary yes if no if, linking the decision to Bitcoin hitting 100K plus and successful AI execution.
The material makes a very strong case for the potential, yes, but our final critique focuses on utility and risk management.
Okay.
To maximize the utility of this analysis for a wider range of investors, the final verdict should introduce a calibrated approach that clearly separates the existing mining valuation from the speculative AI growth premium.
Because right now, the verdict feels a bit like an all-or-nothing proposition.
It does.
You're either high conviction on both BTC hitting 100K and the AI pivot working perfectly, or you shouldn't invest.
And that is the weakness. It fails to give a more risk-averse investor any kind of middle ground, or even a framework for how to size their position.
What if you believe in the 100K Bitcoin target, you think the company is brilliantly managed, but you're skeptical of the AI transition timeline?
Exactly. The current analysis doesn't give them a logical path forward other than just sitting on the sidelines.
So we need a way to quantify that risk premium. The analysis has to show its math for those $25 and $30 targets.
That is the suggestion for improvement. Break down the analyst targets into clear components. Let the reader understand what percentage of that target price is based on the current profitable mining operation.
And what percentage is purely that AI multiple expansion premium, requiring a PE of 30 or even higher?
But is there a risk that assigning a floor value might anchor the reader too low? I mean, the current mining PE of 12 already feels low for their growth rate.
That is a fair point about anchoring. But the goal here isn't to cap the potential, it's to provide a risk framework. We're giving the investor tools for position sizing.
Okay.
The analysis can define the floor generously. Maybe use a slightly higher PE of 15 or 18 to reflect their efficiency. But the difference between that justifiable floor and the high analyst target must be defined as the premium. That's the part the investor is paying for the AI story.
So how could the analysis restructure that final section to make it actionable for different risk appetites?
For a concrete example, it could restructure the verdict to explicitly guide position sizing. For instance, the analysis could state, we assess the valuation floor at $16 supported by the highly profitable mining operation and the existing BTC treasury.
So that's the floor.
That's the floor. Then it would say the gap between $16 and the $25 average target is the implied AI growth premium, which carries inherent execution risk.
Okay, I'm with you.
Therefore, investors should consider allocating their capital into two tranches. The first for exposure to the floor, and a second, higher risk tranche sized according to their conviction in the company's ability to execute on contracted AI megawatts.
That completely transforms the conclusion from a simple recommendation into a sophisticated investment toolkit.
It does.
It gives the reader control over their own risk-reward ratio based on their assessment of the AI execution. That elevates the utility of the entire report.
And it really does. The underlying analysis on the financial strength is undeniable. It's a robust base. These suggestions are simply about maximizing the reader's experience and providing more sophisticated guidance.
So, to summarize the main actionable points. First, rebalance the analysis to give the AI pivot the rigorous financial depth and structural support it deserves.
Right? Move from just mentioning acreage to projecting megawatts and benchmarking that competitive advantage.
Second, provide a more robust, financially detailed explanation for why the market dismissed the EPS miss. Dig into the non-cash charges, especially those linked to that big strategic financing.
And get beyond humans stepped in.
And finally, introduce a calibrated, risk-tiered framework for the buy now verdict. Separate the valuation based on the mining floor from the speculative AI growth premium.
And guide investors on how to size their positions based on their risk tolerance for that AI transition.